people there.
Hello and welcome. Well, the first of the Nifty companies, TCS, comes out with the first quarter earnings, and that is the first quarter of FY20. What we're looking at right now is mixed earnings and perhaps slightly, I would say actually more or less larger than rather expected lines. So let's start with the revenues. They have seen a growth of around 0.4% in rupee terms at around 38,172 crores. Profit remains largely flat at around 8,131 crores. So, well, there's not such a big move here. And the only reason why we are looking at the EBIT number and the profit number, which is slightly lower, is because there's been a slight miss in revenues. But on the whole, there really hasn't been too much of, there's certainly no one-offs for now. And on expected lines, we did see where we were expecting contraction in margins, and that is exactly what we got. So when it comes to EBIT margins, they stand at around 24.2% against the expectations of 24.3%. So that is also largely in line with expectations. Let me get in a voice here. We have Madhu Babu of Centrum Broking, who tracks IT sector for Centrum. Madhu, thanks for taking the time out. What is your initial reading of TCS numbers?
Yeah, revenue is below my estimates. You should see it in the context, because 1Q and 2Q are usually the seasonally strong quarters. So on 1Q, the first quarter, if you have missed the revenues, I think that is going to lead to some downgrade in the revenue growth projection. And in the context of the valuations which TCS trades, I think it is trading at 21.5 times FY21 earnings. It is one of the costliest stock in the sector. So the margin of error for performance is very low. So even a small miss will be taken negatively by the market. So in that context, I think overall, though margin was in line, I think revenue was a bit tepid. So stock has already corrected. I think last 20 days it's down by 7%. But overall, I think there was a marginal disappointment in the result.
Okay, Madhu, also, how are you reading the margins, particularly because that has been a concern of late? What's your take here?
See, margin performance this quarter was in line with my estimates, and this is a quarter of wage hike and H1B visa costs. But having said that, if you say rupee continues to be on an uptrend,
okay,
so I think a lot of sell-side guys. Yeah.
Pardon me, Madhu, I'll have to cut across to the management of TCS. We have Rajesh Gopinathan speaking to us. Here you go.
Registering a growth of 10.6% in constant currency terms. Rupee volatility and rupee strengthening through the quarter dragged that down to 0.4 in terms of reported INR terms. If you look at it from a margin perspective, we have had a very strong margin defense and come in at 24.2% operating margin. From a net margin perspective, we have had a very strong defense at the net margin level, coming from Forex, from Treasury, and from the tax line, so that we have been able to end net margin on a Q-on-Q flat basis practically, which resulted in net margin growing by 13% year on year, offsetting the weakness that we saw on the operating margin line. Cash from operations continues to remain very strong. We have delivered over 8,000 crores of cash from operations and more than $1 billion in free cash flow this quarter, which is a cash conversion of close to 104%. If you look at from a segmental perspective, North America growth has been at 7.7%, and UK and continental Europe continue to grow strongly at greater than 15%. Similarly, from vertical industry perspective, BFSI, which is our largest vertical, is growing at 9.2% year on year, which is from coming off from a fairly steady and accelerated growth that we have seen. So it's nicely consolidating at the high levels that we had exited last year. Life sciences, healthcare, and many of these other smaller industry groups continue their above average performance. Life sciences is particularly strong at 18% year on year. The growth across industries is also reflected in our healthy client metrics. Our customers from whom we make more than 100 million a year have increased by 4 and we are now close with 44 customers from whom we make more than 100 million a year. This strength across the customer portfolio steps down across all levels. So if you look at customers in the 50 million band, 10 million, 1 million, all across, we have seen very steady addition into our customer profile. Digital still continues to be the growth driver for us. We have crossed 32% of our revenues from digital, and which results in a growth of about 42%. We are now running at a rate of slightly more than 7 billion coming from digital services. In terms of employee addition, I'm happy to say that we have had our highest net addition in this quarter as we significantly accelerate our employee onboarding from what we had last time announced to you called the TCS National Qualifier Test. As you recall, we had made more than 30,000 offers to freshers, and we are actually in a process of onboarding almost all of them during the next 2 quarters. So we have brought in close to 14,000 freshers, 12,000 from campus and another 2,000 from off campus. And as we prepare to satisfy our demand from internal resources, as has been our strategy. This quarter, I want to share another important metric with all of you. First of all, quite proud of the fact that we have been awarded by the National Patent Authority as the premium enterprise for patent generation and monetization in India. And the World IP Authority has also awarded TCS as the IP Enterprise with the IP Enterprise Award for the year. So if you look at our patent portfolio, we have been significantly investing in it, and we now have close to 4,600 patent applications outstanding and more than 1,000 patents that have already been granted to us. This portfolio, the applications are up 700 in the last 12 months, and our actual patents granted is also up close to 50%. So we are at about 600, 700. And we are now up to 1,000. We have added 300 new patents granted during the course of this year. So overall, it has been a steady start to our year. We have doubled down on our focus on digital, on our focus on talent acquisition, retraining. Our areas like MFDM, Agile continue to be very strongly resonating with our customers. And we see participation across all theaters and across all industries in the transformation and growth journeys of our customers. With that, I want to welcome you guys all again and open it up for questions. Thanks.
So if I can ask all of you to please limit your questions to 2 or 3, so we have time to get to everyone in the room. We'll accommodate additional questions at the end. So we'll start with Kritika.
Thank you. Hi, gentlemen, and welcome Milind on the panel. My first question, as always, to Rajesh. Rajesh, you spoiled the street a little bit. The street was expecting about 1.5% odd more in terms of Q-on-Q figures. So just to understand, last quarter you had said that there are some headwinds that you're seeing, or there could be some pressure on BFSI in the near term. There were some specific European contracts that could see pressure. So I wanted an update on that. And the fact is that there is a significant macro headwind worry. Is that something that could abate the growth that you have been seeing in the last 2 quarters?
Kritika, let me start by saying that BFSI at 9.2% is significant growth and pretty much the best in class in the industry in terms of the sheer size of the portfolio. As you know, we are the largest service provider in the BFSI vertical globally. So 9.2% constant currency growth on that is a very significant number. Having said that, as we had said last time, we do see some amount of stress emerging in the capital market space across the world and in the European banks in general. That has, what should we say, strengthened through the course of the quarter, and you see that reflected in the numbers that we spoke about. From a macro perspective, again, you know our stance on the macro, so it's very difficult for us to say. But if you look at Europe or continental Europe or UK, both of them are growing at more than 15%. So we continue to participate significantly in the transformation journeys of our customers, and that has been our focus, that we are very client focused and making sure that we are a solution to them as they try to adjust to the new realities.
So at this point in time, Rajesh, what are the headwinds that could affect you as you start this financial year in the near term? And I had a quick question to Ramki after this.
No specific or new headwinds that we can call out. I think the situation has been pretty much similar to what it was earlier. So I wouldn't say that there are any new headwinds that we're seeing that we need to speak about.
Okay, and Ramki, as far as that aspirational band or margin band is concerned, would you be able to come within that in FY20, keeping in mind the fact that forex pressure is more now than it was in the last few quarters? And if I could bring in a question to NGS as well. NGS, quarter on quarter, deal wins have been quite significant. How has the performance been in this quarter?
Yeah, currency is a factor because we've always said that some amount of currency depreciation is intrinsic to our model. So we have seen a lot of currency appreciation of late, and so that will be the only spoiler in a sense. Otherwise, structurally, we believe that we have other elements which are as they have been. So currency will be the thing to watch out.
So would you be able to come within that margin band?
So that's my answer. And so currency nobody can predict.
Yeah, I think we have had another quarter where the overall contract value that we have signed is above 5 billion again, right? That makes it almost 4 quarters in a row now, right, where we have been able to sign contract. We see the growth momentum, we see the demand environment, so that reflects in our decision to onboard the freshers fairly ahead of time, and we are clearly focused on capturing the demand as that we see in the marketplace.
Thank you.
All right, thank you. So you need Quint.
Thanks, Rajesh. Good evening. Couple of questions here. When you came out with the Q4 number, it seemed that the momentum was good. There was deal wins coming in, but going into Q1, we've seen a slowdown, or the pace has slowed down of growth. Can you give us an idea of why we're seeing this trend? Because given the fact that you had a huge tailwind of order wins coming in 2018-19, you would have gone through Q1 with, irrespective of whether there's mild slowdown coming in from BFSI in European markets or capital markets. That's one. From the EBIT margin point of view, 90 bps fall on a QOQ and year-over-year basis. Can you give us an idea of what is that fall, and do you still maintain that ambitious, my EBIT margin thing, or is it time to calibrate that lower given the current realities which are there? And finally, can you give an idea of some of the sectors like retail, BFSI, manufacturing, where we've seen quarter-on-quarter fall, though on a year-on-year it's a double-digit jump. Some idea on that?
See, if you look at from a momentum perspective, actually both deal wins as well as the pipeline continues to be like NGS said, we have done 5.7 billion this quarter, and if you look at it from a year-on-year perspective, that's almost up 20-25% compared to the 4.8 or something that we did in Q1 of last year. So the deal momentum, closures, all of that is high. We are obviously working off a much larger base now than where we were last year, because last year we were coming off from a much lower base. So the comps are much more stretched right now, which is where you see the numbers coming out in that manner. Overall, momentum-wise, other than the specific things that we spoke about, that we're seeing some weakness and we called it early, there's nothing more to call out on that. We're seeing fairly strong growth in the areas that were growing strong, which was Europe, UK, life sciences, those kind of areas are continuing to grow well. So there is not much of it is just that we had a strong year. We were sub 10 digit, we were at double digit last year, and now we are growing on that base. So I'm really not looking for acceleration, I'm looking for sustaining that double digit growth, which we had last time also mentioned about it as a strategy. The margin thing, I think Ramki had answered it earlier. that it is strongly tied to the currency movement. The currency appreciation is counterintuitive. You're given, see, we have given our salary hikes as usual in the April cycle. So that is what gets reflected. You got both the impact of the currency, the Q on Q impact of the currency, and the impact of the full salary hikes and promotions that have kicked in. So 90 basis points in that context is where these are the two levers that are coming in. What was the third question?
Segment like retail, manufacturing, where we have seen some kind of
segmental ones. If you look at BFSI, we spoke about. Manufacturing has been an interesting story. US manufacturing is very strong, in fact, a very bright spot. Whereas UK, Europe manufacturing continues to be soft, in fact, dragged. So, and that has been for some time and for obvious reasons. Retail is a mixed bag. Retail has had very strong growth for the last few quarters. This quarter has been relatively weak for retail. Some of it is coming from some unexpected acceleration in the closures. So Sears and a couple of other retailers whom we had called out earlier, they're fully closed down during the course of this year. There was no resolution plan. So some of that has come in and dragged off. As of now, we think that it is a one-off one. And we should see this bounce back a bit. It is unnaturally low this quarter. We expect it to bounce back next quarter. But as you know, this industry is a bit of a right now volatile industry. So where we stand today, we think that it will bounce back, but we'll have to see.
Finally, is there going to be change in capital allocation plan now that the buyback route has been plugged by the government with a tax coming in?
Capital allocation is about how much you want to keep and how much you want to give to the shareholders. What route and what mechanism to give will always be continuously adjusted based on both the shareholder preferences and the optimum ways of doing it. I think at this stage, I think it's too early to comment beyond that. But capital allocation policy per se does not change. Mechanisms might vary.
Okay, next we have Neha at BTVI.
Hi, good evening, gentlemen. Firstly, you mentioned that India was one of the leaders as far as growth is concerned, about 15.9%. If you could elaborate, where is this growth coming in from?
In India, we are seeing growth across the board, both from solutions like we have our platform solution on the SMB side, ION, that's strong and growing strongly. And we are also more interestingly seeing growth come back from the public sector. So we are seeing strong participation in the public sector side of it as new projects are getting launched, and we are very, very strongly present there. As you know, practically all the large nation building projects, TCS has a very strong track record in that. And recently we have also started winning and getting into it. Also participating in areas like the announcement from the Reserve Bank of India about the new analytics platform that they are building. So there's a lot of activity happening across the spectrum, and we are participating well in it.
Secondly, on hiring, you said that it was the net addition was the highest in the last 5 years. But as far as your attrition goes, that's slightly gone up 11.5% as against 11.3%. So a little, if you could elaborate on that.
This is a seasonal thing. Q1 normally the stage will go for higher studies. What is the key reason for us being going just 0.2% more?
Okay. Lastly, the budget, there was a proposal that the minimum public shareholding needs to go up by 35% to 35%. Your comments on that?
We will not be achieving it by raising fresh equity. Beyond that, it would not be my comment.
But your views in terms of the kind of proposal this is for the IT industry in general?
Not us.
Okay, next we have Ishada with ET Now.
Hi, good evening, gentlemen. So my first question is, Mr. Gopinathan, you had said in the last quarter that you are confident of a double-digit growth in FY20. So do you still maintain that on the back of factors that have been going around, the global macros that we are to see, which have been contributing to the slowdown? And also if you can comment and shed some light upon your digital business in terms of your overall business, and what is the momentum there and what kind of outlook do you have for that?
So we have always been very careful about what we said, and what we said is that as a management team we are focused on getting to the double-digit trajectory and staying there, and there is no change to that strategy. We are fully focused on staying on the double-digit trajectory. Digital, we are seeing broad basing of digital. You've spoken about it that digital is moving way beyond the front end of it and moving more and more into the core. And really what is powering digital growth is integrated solutions across the full spectrum. So you see more of supply chain optimizations leading all the way back to the digital side. If you take BFS, you see wealth management products which are touching all the way to the core banking platform, being able to provide a seamless interface all the way. So if you look at industry after industry, you see digital now stretching deep into the core. We are also doing a lot of work with customers as they transform their infrastructure fully into the cloud, and also as they transform their digital workplace and deliver digital workplace solutions that now leverage new age architectures for the both on the compute as well as on the application side. So it's a full spectrum participation by us across the application stack, the infrastructure stack, the workplace, and the end touchpoint part of it. And I think the spectrum of capabilities that we have and our ability to stitch together those kind of integrated solutions is really where the momentum is coming from.
All right. Also, are you seeing any kind of concerns coming in amid a global slowdown, growth concerns coming in from the US, UK, or Europe?
As we always commented, we are downstream players. There's a lot more of commentary that comes about it, which we also equally read compared to you. Beyond that, we don't have any greater insight on it. But we are downstream, so we will get to know of it last.
Thank you.
Okay, Rahul at Bloomberg.
Yes, hi. Can you update us on Diligenta's performance in the US market? Also, let's start with that first.
Diligenta's performance in the US market.
As you know, we launched the platform in the US. It's going well, and we've transitioned the services, the existing services on as-is basis, and significantly improved the customer experience, etc., related aspects for our client Transamerica to begin with. The transformation that we launched, it's on track, well on our way to achieving that transformation.
So H-1B visa continues to be in the news. If you can elaborate on that, is it still a concern, or it doesn't really bother you at this stage?
I think we've been saying this for many quarters now, and we actually are the top job creator in the US. So yes, H-1B visa constraints we all know, but that is not a constraint for our business today.
Okay. Tushel at Economic Times.
Hey sir, good evening. Congratulations on the numbers. So I have three questions. The first one is the life sciences and healthcare number. The growth is spectacular. Coming at a time when we've seen some rivals say that because there has been M&A in that sector, their business has not been doing so well. Can you give me some color on where exactly that growth is coming from? Have you actually benefited, from the consolidation that's happened there? So the second question is on digital. It's now about 7 billion at a run rate basis. So when would you start, potentially breaking out the subsects in digital? You told us once in the interview that analytics gives you as much revenues as, your BPM business. So there is a way to come to it. But if you could maybe break out some detail on the digital front. And you may not answer this question, Mr. Lakkad, but you're the top hirer in the US, and we've seen companies come out with either statements about we are going to hire X number 1,000 people in that country, or say how many they've hired, or give a localization percentage, say 50% or 60%. Could you give us some color maybe on that aspect in the US?
I'll wait for your answer.
Life sciences, right? So life sciences, in fact, because you spoke about M&A, we have significantly participated on the M&A journey, not from so much from a consolidation perspective, as in actually enabling our customers to execute both mergers, acquisitions, and divestitures in a structured manner, leveraging new age technologies. So this whole space of M&A is a very high area of focus for us. We have significantly learned from it, from our experiences in financial services. But I would say that we have fairly unparalleled capabilities in both the integration as well as diverse teacher activities, and doing that in a very seamless way. So definitely there has been a lot of work that we have done in that space, and we continue to do. In fact, one of the areas that we have highlighted in our past quarter is the work that we have done for a leading life sciences player in Europe, where they've gone through an integration and then they have gone through significant diverse teachers, and we are participating in the whole chain. What was your second question?
So digital, the breakup of the digital.
So I think when we share, while we have continuously been sharing individual data points, a more structured breakup of it will have to wait till we see stability in these lines coming. Actually, digital is a space where lots of services are continuously converging and reforming themselves. As we see stability coming into it, where we'll be able to provide some kind of traceability and trackability of it, we will start breaking it out.
Yeah, regarding, I think you guys it right, we don't give away that metric, but I think what I can say is we are the top job creator in the US. We've been hiring from campuses, from the market, laterals, trainees, all coming in like the way we do it here. So, you know, this is mainstream for us.
Okay, Silky from CNBC.
Hello, sir. Good evening to all of you. My first question would be on the share buyback tax. So just wanted to have your view on it. How do you look at it? Do you think it's a setback for IT industries? Because it has been an efficient instrument so far, you know, to reward your shareholders. Will it still continue to be? And my second question would be on deal wins. So we have seen that in second quarter of FY19, it was 4.9%, and then in FY19 fourth quarter, you achieved $6.2 billion of deal wins. Would it still remain to be between the band of $5 to $6 billion, or do you see it going further?
So on the first one, on a lighter side, I was quite amused to see commentary about how this is a counter to or rather a negative for the IT industry. It is anybody who wants to distribute money through that path will have the impact. It's one thing that this industry has the money to distribute. So because of that, it can't be relatively negative. So it doesn't really, but beyond that, I don't want to comment about it. On the deal wins, there is cyclicality to it, and we have started breaking it out only from last year, so I don't want to comment for periods past that. But there is a very clear annual cyclicality to it. So the right comparison is to look at this quarter against the last quarter. So this is 5.7 versus I think 4.9 if I remember correctly for the last year's Q1. So that's a fair amount. That's almost a 20% plus kind of an increase. How it plays out. 4.9 did not have any platform or one-off deals. So there is no one-off deal in that sequence of 4 numbers that you saw last year. So we'll have to wait and see how this will turn out. But our pipeline and qualified pipeline both continue to be quite strong. So I would expect that we should be able to continue the momentum.
Okay, Ramita with Business Standard.
Hi, I just want to understand in terms of talent costs in the US, has it gone up? Is it still high for that matter? That is one. And second would be, you just recently increased your stake in the Japanese JV. So any particular opportunities that you see in that region?
Let me take the Japanese JV one and then let me take that. So the Japanese JV transaction has been a very structured, systematic one. Actually, the JV itself came through a series of long-term investments that we did. You might be aware that we have been in the market for quite a long time. We in fact set up another entity jointly with Mitsubishi first and ran it as a separate entity. Once they got comfortable with our management philosophy and our style of working, they then decided to merge our standalone entity, the JV, and their standalone entity into one single entity. It is along the same lines that as their confidence has grown, they have decided to reduce their holding to 33%, but continue to be a very strong JV partner for us. and it is more a reaffirmation of the maturity of that JV and increasing ability for it to address and the comfort that it has given to the local stakeholders. So we are quite happy with where we are on that side. It has been a long journey, and we've been quite focused on it. It's a market that many people have tried to enter and better. So we have been very clear that we are in there for the long term, and that is also reflected in the JV partners' confidence in this venture. So on for the next 5 years. 5 years in, 5 years, setting our sights for the next 5 years in the US.
We have been hiring in the US for many quarters now. So, and we that's all those costs are baked into our cost today. We don't see an increase anyway.
There's no specific talent crunch issue as of now.
No, there is a talent crunch issue, but we still have, even with the talent crunch, we are able to meet our customer expectations and deliver for those customers.
Shubhra with Financial Express.
I think most of the questions were answered, but on the buyback issue, are you likely to consider some other mechanism apart from buyback? Is there anything, or this continues to be a popular way of returning the shareholder value back?
I don't want to comment on that because I don't know. The frank answer is we will deal with it once it gets finalized. The board will look at it and consider what are the other options of looking at it.
We have time for a few more questions. I believe Kritika has another question.
Milind, the point that Rajesh was making on the revenue front is relevant, of course, on the employee front as well. You have been at a non-linear trajectory over the last 6 to 7 years, of course, but considering that you had one of the highest net additions this quarter, is that something that's going to start reducing over a period of time? And what's your strategy for this financial year in terms of net hires, and if you can give us a breakup of campus and laterals?
That we normally give out the offers what we offered in India, which is 30,000 we did this year. With respect to your question on employees, it's like similar to asking guidance for revenue. It is, so my overall increment or addition will completely depend on the demand which is coming in.
Okay, and for 30,000 in India specifically, is that campus or
30,000 campus offers we made.
Campus offers. So it's going to be more or less in line with FY19 for FY20. The outlook in terms of hires.
The point is we keep evaluating every quarter, and based on that we make decisions on lateral hiring, and also if we need to do something else.
Okay, and attrition also 11%. How sustainable is that? And is it also because you had the large rounds of appraisals, etc. So Q1 typically you have a lower
Q1 normally is a seasonally we have a attrition going up with 20 basis points because of two reasons. One is people normally going for higher studies, and also some people leaving after the appraisal cycle.
Okay, and lastly, if I could ask a quick question to Rajesh and NGS. Rajesh, just a broader point. Are you as confident about the deal pipeline? Because in Jan, it seemed like customers were taking some more time in terms of client budgets. So are you as confident as you were in Q4 about what lies ahead? Has there been more clarity from clients in terms of how much of an uptick there will be? And if NGS, you could throw some more light onto out of the order pipeline that you are seeing, what specific contracts in terms of digital, what are the areas that are giving you more traction in terms of numbers?
From a confidence perspective, I think we remain as confident as earlier. And as I said, there is no new headwinds or nothing new that has materialized on the picture. It's been an even kind of a scenario. Beyond that, almost across the industries, the things that we have called out, I spoke to you about BFSI, I spoke to you about retail. That is what there is. Otherwise, we don't see any specificity to it.
I think Rajesh articulated about the type of digital projects that we are doing. I think a few quarters ago, we had also clarified that almost everything that we do will become really digital. Or digital will become part of every single project that we will be contracting, will be doing. while some of the other things that will continue, but largely digital will be embedded into everything that we do. I think cloud and moving customers' application infrastructure into a hybrid cloud is one of the popular exercises
Even
that's
in
going
terms
on.
of numbers, in terms of the
In terms of
big
numbers.
order book?
In terms of numbers as well. Then payments related transformation and embedding and the payments in the front end as well as all the way hitting the core, as Rajesh explained. I think that's one area where we see significant opportunities in the financial services space. We're also seeing traction or increased visibility of customers looking at blockchain, right? Specifically in terms of how transactions can get processed more instantaneously between the participating customers and banks with respect to the in-market infrastructure institutions. So one of the innovations that we came up with in the area of blockchain, specifically in the clearing and settlement area, has been recognized as the best blockchain breakthrough for the current year.
Ramki, one clarification on the finance cost. Last whole financial year it was around 200, and for the first quarter alone is 257 crores. Just can you give some elaboration on that?
Yeah, see, there is a new accounting standard which has come.
So it's primarily on leasing.
Yeah, all the leases which we have. So there is a, so you will see that a line on interest cost will be there in relation to the new leases when we sign up. So there will be, earlier it could have been treated as a rent. Now it will be treated as partly as depreciation and partly as interest.
So, so basically from an operating cost it comes down to your finance cost. That
partly, not all of it. Most of it goes as depreciation. Some part of it will come as.
So a large part would have gone into finance cost because
no,
on a quarterly
really.
basis it's around 50 odd crores. That's your finance cost.
No, from a number perspective, 379 crores or so was the rent, which is less this time, and 270 odd crores has gone in depreciation, and about 119 crores has gone in interest. So it is predominantly on the depreciation rather than on the interest.
There's a gentleman in the far left corner. When you ask your question, can you just state your name and media outlet, please?
Prajesh from Z Business. Sir, in your consolidated balance sheet, there is an item write-off use assets, which is 6,290 crores. It was not in the last quarter, so what is that?
That's again with to do with the new accounting standard. So typically when you have leases, over a period of time you will charge those lease rentals. The new accounting standard asks you to take all that and capitalize it, and that is called as right of use assets. So that's a new item. On the reverse side, it will be on the current liabilities or borrowings in the case of Ind AS. So it's a new standard which you will see across all of corporate India, I would believe.
We have another. Oh, you have one more question? Over here.
Hi, Rajesh. Ken Koyanagi with Nikkei Asian Review. May sound kind of philosophical, but are you observing a change in nature of IT spending in your client companies? Which means, companies used to be cut down on IT spending when economic down cycle comes, but because of the depth of impact of all those newer digital technologies in their core strategies, IT spending might be becoming something you cannot cut down on, you cannot save. Is it fair to say so?
Pretty much. So if you look at our commentary through last year and beyond, before, if you take an industry like retail, which went through its most significant transformation or disruption and was under tremendous stress, what we saw was technology spending was the one thing that they were trying to protect and over-invest in as they tried to restructure themselves into a brick and mortar plus online retailer kind of scenario. So that's a great example of a most dramatically visible scenario where technology spend becomes a strategic investment rather than a back office cost. The theme is playing out in multiple industries. So you're seeing this in banking, you're seeing this in manufacturing and others, but the relative visibility of it is much more dramatic in retail just because of the nature and the speed at which they went through it. But the same theme is playing across. in auto, every single product launch now is as much a technology project as it is any other form of engineering. In North America, one of the big OEMs is going through what they're calling virtualization of engineering. So going from testing on the roads to testing on the simulation-based testing to predictive model-based testing. So going from road to model to simulation to data, and that path is almost inevitable across industries.
We have time for one more question, if anyone has a question. If not, we can conclude. Thank you everyone for coming. Snacks and drinks outside, and broadcasters, please come forward to set up. Thank you.
How many